Let's get down to basics today and break down exactly what is a mortgage. I know, first thought is, oh, that's easy. It's my house payment. Well, yeah, it is. But what is it that you pay every month that you call your house payment? A mortgage is defined as a debt secured by the collateral of a specific piece of real estate that the borrower, that would be you, is obliged to pay back over a set period of time with a predetermined set of payments. A mortgage is different than other types of loans, like a student loan, because if you violate the terms of the mortgage, the lender can take back your home. What? Yep, it's called foreclosure, but we don't want to talk about that today. There are many types of mortgages. Most are for longer terms, typically 15, 20, or 30 years. Since this is a large financial debt compared to, say, buying a car, your loan amount is based on the purchase price of the property minus your down payment. Down payments can also vary and can be as little as 0 down to well over 20% down. If you put down less than 20%, you may need to pay mortgage insurance. I talk about that in a different video, so make sure you check that one out. Once you have your term, your interest rate, which can be fixed or variable, and your loan amount, you can determine your payment and amortization. Amortization is important to understand. Amortization is the process of paying off debt over time in regular installments of interest and principal sufficient to repay the loan in full by its maturity date. Your monthly payment will stay the same. However, you are paying off a little bit of the loan and a little bit of the interest with each payment. The portion of the payment going to principal or interest will change each month. You will mostly be paying off the interest when you start making payments. And then over time, your payments will start to go to the principal balance of the loan. One way to think of this is the home is split between what the person owns, the equity, and what the lender owns, the debt. In our example, we will use a purchase price of $500,000 with 20% down for a loan amount of $400,000 and a 3% fixed annual rate amortized over 360 months or 30 years. Day one of ownership, the buyer, that means you, owns $100,000 of the home. This is your initial equity. With each payment, you own a little bit more of the home and the lender owns a little bit less. In our example, the monthly principal and interest payment is $16.86 and 42 cents. Most mortgage payments will usually include property taxes, homeowners insurance, and any required mortgage insurance in the total mortgage payment. After 360 payments, that's 30 years, the total paid is $607,110. That's a big number. With the total interest, $207,110,000. You will see in the grid how the initial payments pay more interest, and at the end of the term, your payment goes more to principal. Have more questions? DM me or give me a call.